Morning, everyone. This is Barry Knapp, Ironsides Macroeconomics. Today is Monday, March 8th. Our report this week was titled Bretton Woods II. This is our weekly podcast and YouTube video describing that. And this was very much a longer duration thought piece, or at least the bulk of the note was. There was an important message in the note that we'll get to in a second about current market conditions and our decision to put some capital to work on Thursday afternoon. But the real crux of this note was the longer term thought piece on the global currency regime and the rise of crypto and trying to create a framework for that. So to begin with, our first section was titled Powell Has No Idea. And as we listened to Chairman Powell's Wall Street Journal event on Thursday morning, we chuckled to ourselves thinking about Jim Cramer's rant about Bill Poole back during the early stages of the financial crisis. And in our view, and we had written this and then foreshadowed it in a preview to our full subscribers, that we did not believe there was any way that Chairman Powell was going to hint at a maturity extension program or Operation Twist or anything like the yield curve control that was all over our Twitter feed on the last couple of days, or the days during the middle of last week when the market bond market had sold off so much. But as we listened to Chairman Powell say that the rates market was reflecting the stronger economic outlook, we don't, as our readers and those listeners know, we don't really believe that's the case. Yes, the growth outlook is improving. The inflation outlook is definitely changed significantly. But the real crux of why the bond yields have moved up so much, as evidenced by the movement in the longer term securities, and remember the Fed's average duration of purchases is only 6 years. And so when you look at the 30-year real rate or TIPS yield, you're really seeing the pressures of the increased supply that's coming from the additional 1.9 trillion in deficit financing, adding up to a total of 5.3 trillion in deficit financed government spending and counting, right? And the Build Back Better plan is coming down the pike next. So this is what's really moving the market. And Chairman Powell can't possibly say anything about that in his defense. We were trying to be funny with our Powell has no idea, but he could not possibly criticize the fiscal spending in any way or even intimate that the market might be reacting to that. But that is indeed what we think is going on. Now, we do think that the market has moved far enough, at least for now. From a technical analysis perspective, the bond market's achieved technical objectives and goals. We don't think there's all that much convexity pressure. Remember, some 2/3 of the mortgage-backed securities market, which is generally that creates that convexity, that volatility related selling. 2/3 of that market's held by non-hedgers, a third by the Fed and a third by large banks who put it in their held to maturity account and forget about it, so to speak. So we didn't think there was any real convexity. On the negative side, the Fed was never likely to do an Operation Twist type of program, at least not yet. They will, we believe, make the decision to extend the exemption to cash and treasuries from the supplementary leverage ratio, SLR, and that'll help a little bit. But frankly, we've been looking at bank purchases of securities, treasuries, and they've just continued to pace. So maybe they've shortened the duration, but so you've got bank demand for treasuries as well, with all the massive reserves that are getting created, in part because the treasury's going to issue far fewer bills and basically inject some $1 trillion of liquidity into the system over the next couple of months. So again, those all push against the bond yield continuing to rise. And then there was a very interesting segment on CNBC this morning where Joe Kernan had spoken to David Tepper, and Tepper noted that the cross-currency or currency hedged return to Japanese investors was the highest it had been in 5 years. That's, Japanese demand could help stabilize the market as well. So we appreciate all that. And remember, our framework for an equity market correction in this environment was a 10%er would require a serious change in the monetary policy regime, i.e. tapering and slowing the asset purchases, or at least changing the mix, or talking about tapering. The Fed's doing nothing of the sort. We will also need another potential trigger for a 10% correction would be an introduction of the Biden tax plan to fund the infrastructure spending. We may get that before too long if they begin immediately discussing the Build Back Better plan. But for now, when the market was down 5.75% on Thursday afternoon, that for us fit the parameters of the outside range on what we expected for a correction. And so we put some money to work in S&P, in part to get a little more technology exposure, because we thought that part of the trade had probably been overdone. But we also went max on the reflation trade and bought energy, even though it wasn't down that day. So we did, because we've been talking about this, we felt it was important to put our money where our mouth is and put some money to work on Thursday afternoon. So that's what we did. Any weakness this morning we think could be bought as well. The next section of the report this week is we titled it, and this was a summary of the payroll report, which was restaurants reopening. Now what about schools? And once again, we had sort of a misleading headline in the employment report. The last 2 months, the headline was weak. The underlying report was pretty strong. This one was the opposite, but there were some fairly significant extenuating circumstances. The headline was influenced by the reversal of the big decline in leisure and hospitality employment that occurred in December. It snapped back in February. We don't really think it was ever quite that volatile. We think the government's struggling mightily with seasonal adjustment factors. The pandemic has changed spending patterns and people's vacation patterns and all that sort of thing. And that seasonal adjustment factor, and the numbers are huge. So the seasonal adjustment factors has distorted some of these changes. But there was a serious weather effect in place in February that without it, we would not have reversed the big increase we had in the work week in January and February. And what we mean by that was people unable to work due to bad weather was 897,000 last month against a typical February of 309,000. And you had an additional 1.878 million people that worked part-time that would typically work full-time. So there's your work week decline. So on balance, and additionally, we saw a increase in the employment to population ratio for prime age workers. That's people 25 to 54. That went from 76.1% to 76.5. It's still down from a year ago, as we've cited female employment as a part of that, but it's no lower than it was on average throughout the entire last business cycle. So we think that that'll all snap back. And we chuckled when we heard President Biden say we have 1 million educators who aren't working. Well, that's because of primarily because of recalcitrant teachers unions. So go back to work. That would be our answer on that one. Then we also wrote a little bit about a Chicago Fed paper that we put the link to the note, the full note that is for full subscribers, from the Chicago Fed, talking about reallocation and saying how it hasn't been a reallocation recession as of yet, meaning people haven't changed professions, haven't really moved around. We dispute that reallocation assertion to an extent, because the three sectors most affected by this are the three most dynamic, most reallocation oriented sectors. That's leisure and hospitality, retail, and construction. And there's been a lot of churn in those sectors for sure. But we've also seen a surge in business creation. That happened last year, slowed down a little bit at the end of the year, and is surging again at the beginning of this year. Also, the ADP size breakdown, businesses with 1 through 49 employees have regained 66% of their employment, and large businesses over 500 employees, only 42%. So there's been plenty of reallocation and dynamism. It'll be interesting to watch whether it occurs across sectors once the pandemic really recedes, and whether there are some permanent changes. There are some permanent changes for sure, because it accelerated some trends that were already in place. But nonetheless, we thought that was an interesting topic and worth discussing. And we do expect, the net message here is we expect some very strong employment reports in the coming months. The underlying tone to us still looks quite strong. So that was it on the more current stuff. We then spent quite a bit of time last week, and we've been doing this for quite a long time, researching what we call the road to Bretton Woods II. And we obviously have an inflation outlook. We've extended our 1960s early analog. The chart that I'm sharing here shows you what happened to gold reserves through the course of the 1960s, when inflation accelerated, when Nixon ended gold convertibility and the yen was finally revalued significantly higher, and how the Bretton Woods collapsed. And this report carries a bunch of references, good resources to think about this. But our core argument here is that we have a very unstable regime, and it is entirely probable, we think, if possible, if not probable, that there is going to be serious pressure on the global currency regime. And it is very unclear that, and I'm not arguing economics here, this is a little bit more the political economy and politics, that the price for the US being the world's reserve currency is a price that the US public is willing to pay. And you see from that prior chart that I had up and some other charts in the note that our goods deficit has just continued to rise. Many believe that we need to run a big goods deficit to create the supply of dollars for the world's system to work. In essence, that very nature of the fact that we're the reserve currency condemns us to running these massive trade deficits. And as we know, those trade deficits have become increasingly untenable, as evidenced by the rise of Donald Trump. So we do think that this is, in some ways, explains the rise of crypto as well. And we would not be surprised to see a new Bretton Woods formulated out of some of the pressure that's going to build once the crisis reaction ends and we get into the rest of this business cycle. So that's all we're going to give you on that, really, because we'd very much like you to become a full subscriber. As I said, there's a lot of resources in this note and a lot of thought given to it. We're going to refer to it often in coming weeks and coming months for sure, because we do think that this is going to be a big part of the story in the 2020s, the whole deglobalization trend. So that's it for me this week. This is Barry Knapp, Ironsides Macroeconomics. If you're not a full subscriber, we'd love you to continue, or we'd love you to consider becoming one. We do offer 30-day trials. If you want to read the report and get a sense of whether you think our content is worth paying for, we'd by all means send us an email and we'll add you. So have a good week, everyone. Barry Knapp, Ironsides. Thank you.